What should we be considering before end of year as far as advanced tax strategies, Eric?
Well, there's a couple things. What type of year was it for you, right? Did you get laid off? Did you have a job change? Things like that. So sometimes when people had a lower income year, it makes a lot of sense to do Roth conversions to pay some of that tax now and just avoid that tax for the rest of your lifetime. And so that can be really good in a year that's down, or maybe you've retired and you don't have as much regular income coming in. That can be one option. Tax loss harvesting is another kind of fancy term.
Mm.
Right now, the S&P 500, there's about almost half the stocks are negative and half the stocks are positive for the year. So if you have some gains this year, you could actually sell some of those losers, offset the two, they wash out, and that's one way to mitigate a lot of taxes. And there's studies that have been done that if you do this the right way, you can add about 1%, 1 to 2% over annually to your returns by just having the tax savings. Obviously, it's only for taxable accounts. Doesn't matter for your IRA.
Okay,
but
okay. Yeah.
and then also the other thing too is just charitable donations. There's a new thing this year for charitable donations where anybody, even if you do a standard deduction, can write off $1,000. So that's one thing is make sure you've done some before year end. But also, if you've got a stock that's shot up a bunch, and you can donate that stock instead of donating the cash, well, the nice thing is you don't have to pay tax on that sale of that stock. You get the full write off. Charity gets the full amount of the money because they don't pay the tax either, and so
Yeah.
you both win. So there's some actual tax planning that you want to do. Hard part, of course, is getting short on time, and
Yeah.